Hey everyone, I'm Roger Herring. I am the investor's accountant. Welcome to my office for another edition of Ask Roger. You know, here on this channel, we love to talk about tax avoidance, wealth building, generational wealth, real estate, cryptocurrency, all those awesome things that fit right into a wealth building strategy. So today I want to talk about C corporations, when you should use them. A gentleman came up to me at a networking event and asked me, he said, hey, I'm thinking about doing a C Corp. When should you use a C Corp? And I gave him my standard reply. Not very often, because there's a lot of really bad information out there about C corporations in general. You see, years back, Robert Kiyosaki, when he was writing all the Rich Dad books, was a real proponent of C Corps. And the law at that time was totally different than it is right now. You see, back then, a C Corp had a progressive tax rate. That meant that the first dollars are taxed at a lower rate than the last dollars. So the first $50,000 of income in a C corporation was taxed at 15%. So this was great for someone that was in the top tax bracket because they were a higher earner and decided to flip some properties over on the side. We'd use a C Corp, we'd pay a whole lot less tax, get the money out, and proceed forward. It was great. Then the law changed. In 2018, the Tax Cuts and Jobs Act changed the C Corp. Well, what did it do? Let's just talk about it. All right, so here you have it, guys. Here's the C Corp. It's a separate business structure. The owners are shareholders and the entity is taxed separately. That law, the Tax Cuts and Jobs Act, changed the tax rate from a progressive rate to a flat tax of 21%. So $1 is taxed at 21% and the last dollar is taxed at 21%. Simple math. If you made $100,000, you are going to pay $21,000 in federal income taxes. Oh yeah, and don't forget, if your state has income tax, you're going to pay that too. Second thing about C Corps, you don't ever hold appreciating property in them because they don't have any capital gain tax rates. Yeah. And if you wind up paying dividends, there's possible double taxation. Now, it's not so bad anymore because you can get it taxed as a capital gain on the dividend, but you're still paying tax at corporate level, and then you're going to pay tax again at individual level. 21 plus 15, you do the math, okay? There's also a limit on how much money you can leave in the C Corp, a retained earnings limit. You can only leave $250,000 in there plus 1 year's operating capital. If you have more than that, then you're subject to this nasty little thing called the accumulated earnings tax, and you have to pay dividends, which means more double taxation. So my estimate is about 95% of the people that ask me about C Corps have no business being in one. So what do we use C Corps for? Well, there are some great things to use them for, and right here, this is my favorite one. This is called the master lease strategy, and I've got a video on it so you can look at it in detail. But this lets us turn a short-term rental into a long-term rental for tax purposes. This makes it easier to claim material participation because the IRS has some specific regulations. You want to know more about it? Please go check out the video. The way it works is you set up a C Corp and you lease your property on a long-term lease to the C Corp. Now the C Corp turns around and offers everything on Airbnb. Airbnb pays the C Corp. The C Corp pays all the cleaning, the maintenance, etc., the things that your tenant would normally pay, and then they pay you a rent. If there's anything left in the C Corp, it's going to be taxed at 21%. But hey, this way, we can be a hotel, charge higher rates, provide services, so we get to have our cake and eat it too. And you know what? When my clients have 1 or 2 short-term rentals, I prefer this strategy for them because it makes their lives and our life easier. Now, let's talk about another reason to use this. How about a health reimbursement arrangement? See, the health reimbursement arrangement, it's an employee benefit, and it turns medical expenses into deductible business expenses. You know how hard it is to deduct medical over on Schedule A. Well, under an HRA, you can be reimbursed dollar for dollar, and there's no 7.5% floor like there is over on Schedule A. Now, this is only for ordinary income entities. So if you are flipping property or you got a business, now be careful because you don't want to do this with employees because you have to offer them this as well. This is great for solopreneurs. Okay? The S Corp, however, can't have one. Okay? S Corp cannot have one. So if you're married, you'd use the family support company, and I've got a video about that out there. If you're single, you use the C Corp, you become an employee of the C Corp, and one of your benefits is the HRA. Okay? That's the second reason. Here's the third reason. We're going to use a multiple business strategy, also known as streaming. One of the reasons we might want to move money around and get it out of a certain business and into another, it might be that we're in the top tax bracket and we need to move some money off, or we're trying to qualify for a specific tax credit, like perhaps the education credits if we have children in college. So what we can do is side stream income. That's where we take a specific revenue stream out of our existing business and put it in a totally separate business that is structured as a C Corp. My first business could be a partnership or a S Corporation. We would have the second business where we're side streaming to be a C Corp, so it's taxed separately. There's also the upstream. That's where you create a separate entity that bills your existing company and moves income from your company up to another level. You can also downstream. So let's say that you are already in a C Corp and you need to get money out. You can do the reverse and contract with your S Corporation. Now, here's the thing. Look at that last thing. If you got to take money out and you need every dime to live in, guess what? You don't need a C Corp. Okay? If you have to use every dollar that you make to live, no C Corp, no way, no how. All right? Finally, we use them as a blocker corporation. See, we're going to use it kind of with a self-directed IRA. See, if you invest in ordinary income streams with your self-directed IRA or self-directed 401k, you may have a problem. You see, let's say that I wanted to flip properties. I can flip 3 properties a year. But if I do more than that, that rises to the level of a business, and it's going to trigger this thing called unrelated business income tax. That is a tax at trust rates. Now, even with paying it, I'm going to make more money than I would on Wall Street, but I can avoid it by setting up a blocker C Corporation. I invest in the C Corporation stock, and the C Corporation flips the property. What are other uses for it? Well, let's say you're doing crypto mining. That's ordinary income. If you're doing it with self-directed IRA or self-directed 401k, now you want to use that blocker so you're not having to pay UBIT, which is actually a higher rate than the 21% corporate tax rate. Okay? There you have it, gang. Those are the main reasons that I use a C Corp. I do not recommend using a C Corp for your day-to-day business when you are a small business, and I never recommend it when you're starting out. You almost 99.9% of the time need to be in an S Corporation. That's it for today. If you got any questions, shoot them to me. Till the next time, Roger out.